Hello, investors. Welcome to one more monthly interaction with Canara Robeco. Uh, Last month clearly has been an eventful month. From a global macro perspective and geopolitics perspective, we have entered in a new event. We exited the event of tariff mostly in the previous year, and then in last month's start, we have entered into a new geopolitical event, which is the Iran-Israel US war. And I think everything is revolving around that in terms of how it is likely to impact the globe and India. Clearly, if the event were to persist for a longer period, it will have a repercussions in terms of demand slowdown globally as well as locally. It will have implication in terms of supply chain disruptions because a lot of supply chains which are dependent on the gas value chain are getting disrupted at the margin. So clearly, if the event were to persist for a longer time, it has serious implications. Having said that, like what we alluded to last time also, if you go back and look at the history of 30-40 years, typically most of these events from a market perspective, from economic perspective, have been short-lived events. And that's why they are called as events. Whether you take the GFC, whether you take the Fragile Five event in 2013 as far as currencies are concerned, whether you take COVID, whether you take the Ukraine-Russia war, most of these events, if you look back on them in terms of the after 18 months or 24 months, they turned out to be an opportunity rather than threat. And thus, as of now, basis the historical base case, we are going with the base case that there is a limited appetite, particularly from US's side and Iran side, to continue this war, while Israel has a lot of appetite in our view, basis whatever public information is available. But clearly, from US side, it is very, very evident that they want to exit the war as early as possible. Clearly, we are going with that base case that while it has not concluded in the initial estimate that we had, which was 4 to 5 weeks, it is still continuing. Our assessment still remains that it is more likely to be a short-lived event. We are going to have another 1 or 2 weeks in terms of, or 3 weeks in terms of this event. Basis how you read the situation rather than it being a long drawn process. Having said that, again, yes, if it were to be a long drawn process, if US were to actually destroy the core infrastructure of Iran, and if Iran were to retaliate in terms of trying to destroy gas and oil infrastructure in the region, then while the event can be short-lived, but its implications can be long-term, and that's the downside risk that still remains. But as of now, we are going with the base case that when the impact of the already happened event have been witnessed by both US and Iran, at some point in time within next few weeks, they will come to the table and this event will be concluded. That's the way we are looking at this event, and that's where we see it from an investor's perspective. When they take 12 to 24 months view, we see more of it as an opportunity rather than threat, because whole last 2 years what people were actually wanting to buy companies at a cheaper price, now cheaper prices are available. Of course, they are coming with the uncertainty of the event. That's the global geopolitics. Of course, how it runs through the economy is very, very critical for people to understand, because that also actually helps them to appreciate the risks that this event has if it were to be long drawn. Number one, clearly a very, very strong macro that we were exhibiting actually comes under a little bit of a question mark, because every $10 increase can lead to 0.3-0.4% of increase in current account deficit through the energy prices increases. So by now, as of now, while the government has not passed on the prices, from government side, the current account deficit impact is already 1 additional% if it were to sustain for a year. So a 1% current account deficit that we were witnessing as of now can move to 2%. That's one impact. Second, of course, whenever the energy prices will be passed on, it will have an impact on the economic activity and the demand. That will have an impact on the basically overall GDP growth rate. As of now, both globally and locally, people are estimating if the event were to persist, it will have an impact of anywhere between 50 basis point to 1% for a year or 2 year, depending on the context in terms of GDP growth rates. Third, It will also have an impact on the fiscal deficit of government, because meanwhile government will end up supporting or taking the additional burden of the additional fertilizer costs, additional oil and gas costs, which will not be passed on to consumer. And so whether it is current account deficit, fiscal deficit, growth rates, or and lastly inflation, which has been running very low, there are estimates that anywhere between 70 basis point to a percent of higher inflation can be witnessed if this were to persist for a longer period of time. So these are clearly the risks that people need to keep in mind if the event were to persist for longer period, and if it were to persist and lead to the impacts, whether it is macro impact or micro impact. So that's the global event. Clearly this is the event at play, and it's the most critical event that is happening right now, not because geopolitically it is important, but all the importance actually flows to the Asian countries and particularly India through the energy channel, whereby we are significantly dependent on the import of energy from Middle East. So that's the of course the global piece. Coming to local, as of now, when we look at the macro or the corporate earnings growth, we don't see the earnings growth having any significant impact even in the fourth quarter. So earnings trajectory as of now continues to be on an improvement mode. But of course, again, lot of it is to depend on how this event actually closes and how fast it closes. That will define whether we actually have earnings downgrade for financial year 27-28 or not, particularly financial year 27, 12-month visibility at a point in time. So that will depend on how the event actually concludes or not concludes, and how fast it concludes. But as of now, as we have been alluding to last several conversations, the earnings trajectory from financial year 25 5% to financial year 26 anywhere between 8 to 9% for the financial year, as consensus has penciled in for financial year 26, and which was likely to move into mid teens in financial year 27 and 28 on a CAGR basis. That stays, and we'll actually reevaluate our assessment if the event were to, if this war were to persist even in the first quarter for a longer period, I think. But as of now, the market has reacted. The market has already assumed that there will be earnings cut, and that's how market is behaving. The market is already assuming that the event will be there for some time, and that's where, if the event were to conclude, you will also have reversals which will be very fast. So that's the piece on earnings. As of now, still earnings growth which is recovering from where it was if the event were to get concluded faster. Basis this, the valuations now have become far relatively more palatable as compared to where they were. The valuations now for Nifty is trading at roughly about 18 times financial year 28 numbers, consensus numbers, which is largely in line with or lower than the last 10 years average valuations of Nifty. So clearly valuations are far more palatable, but so is the uncertainty. And typically markets are such that then when you get something at a very attractive valuation or relatively palatable valuations, of course it comes with the uncertainty. When uncertainty was not there 2 years back or 1.5 years back, the valuations were also expensive. So that's the context in which we are operating. It's clearly basically a demonstration of how market investors behave in a greed and fear environment. When there was greed, the valuations was high, the implied returns were low, the earnings risk were relatively low. Today, there is a lot of fear, there is a lot of uncertainty, and that's where the valuations are palatable. The earnings, at least from a market perspective, have been discounted in terms of earnings cuts. Clearly, market is building in that the event is going to be around for some time, as the prices are suggesting. So that's clearly can be looked as a threat or an opportunity. We at this point in time are looking at this as more of an opportunity rather than threat, because that uncertainty has brought in this opportunity, and our sense is that when the push is enough, there will be a lot of stakeholders who would get involved, and the issue will get resolved. And US clearly has an indication. From US side, there is a clearly indication that they are not very keen to persist with this for a longer period. So that's the base case with which we are working as of now in terms of how this war shapes up. Uh, in terms of uh, how I think one of the risks that has persisted is also because India is most vulnerable or relatively more vulnerable among the emerging markets to energy prices. Uh, we have taken a larger knock. The FIs have sold roughly 1 lakh 40,000 crore or 1 lakh 50,000 crore worth of Indian shares in just first 3 months, which they sold virtually in the last entire year, clearly indicating the kind of basically uh, aggressive selling that one of the large stakeholder has done and which is reflecting in the market. Uh, I think that risk is also gradually reducing in our view because there is a lot of selling, $25 billion last year, 25 billion, 2020, roughly $20 billion, almost 15 to $20 billion in first 3 months itself. So we see at some point in time that part also actually getting resolved because the currency is also depreciated. So that's where we are for last month. I think clearly all about war and when the war ends, and the uncertainty and the opportunity that this war represents or the threat this war represents at this point in time at least, uh, till the time the infrastructures of the energy producing countries, whether it is Saudi Arabia, Qatar, UAE, uh, Kuwait. Uh, I think if infrastructure is not hit, I think this will be a relatively short-lived event, and that's how, as of now, we are actually thinking in terms of the event. That is the base case with which we are working. That the warring parties will be rational enough to not go to that stage. If if the war were to go to that stage, I think there are lot more. Then there is lot more pain that can come. The way of the society in general, Middle East in general, and the whole world in general, we are not actually penciling in that case as a base case as of now. So that's largely from our side for the month that has gone by, and let us hope that the war comes to an end in the coming month. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.